if the central bank of central banks is clearing up their shorts, why are people shorting this product?
Ignorance, I guess.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, the community keeps growing more and more every single week. So thank you so much for your support. And there's a lot to talk about during these historic times. And Andrew Maguire is in the house with an industry expert, and by popular demand, of course, Dave Kranzler in the house, and we'll be talking gold right here. And so with that, it's going to be an amazing episode. You won't want to miss a word here. Live from the Vault gives you access to information and updates you just can't get anywhere else, and this episode will be no exception. So just before we go to talking gold with Andrew Maguire and our special guest, David Kranzler, please help us spread the word by this liking the channel, sharing it, hit that subscribe button, you know the routine, and hit the bell right there if you want to be notified as each episode goes live. So let me introduce our special guest for the few of you that may not know Dave. Dave Kranzler is a hedge fund manager, a special metals analyst, and the author of a bi-weekly subscription newsletter called The Mining Stock Journal. And after years of trading expertise that he built up on Wall Street, Dave now co-manages a Denver-based precious metals and mining stock investment fund and strives to help people understand the truth of our financial system and the economy. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, David Kranzler. Over to you, Andy.
Dave, so good to have you back, my friend. Been looking forward to this. It's only been, about 6 weeks or so, but we said we need you back. So here you are.
I appreciate you having me back on. I always enjoy doing this show. It's a lot of fun.
Yeah, and I think, in fact, I was just looking through some stuff a couple of days ago, and in a recent Kinesis article, what you did, it was interesting because you authored, and this is something which is good because I don't usually think about this stuff. You authored about drawing attention to the mining stock index ratio to the S&P 500, and then you were looking at recent similarities to 2001, when I guess you were saying that mining stocks bottomed, and that was following a huge multi-year bear market from, I think, 1980. You said, can you walk us through that, Dave? It was so interesting.
Ooh, I don't have the chart in front of me, but essentially what that chart shows is that the mining stocks are extraordinarily cheap relative to the rest of the stock market. And in times when that's been the case, it's paid off well to sell your general stock market exposure, or at least cut it down and get really long the mining stocks.
Which is, of course, I love drawing on that information from you, because it's something that, again, I'm quite open about it. I don't, until I've spoke to you, I really didn't even start thinking about the miners. And obviously we bear in mind what the indexes are doing because it also tells us what the big boys are doing. But
now that I think about it, because I did stick that article on my blog, and part of the thesis was that, by the traditional definition of value investing, the mining stocks are an incredible value right now. And one example I like to use, and I'm not saying I'm coming on your show to recommend Fortuna Silver, but Fortuna Silver is trading at almost half of its book value, its tangible book value. And I know that probably starting in 1999, we threw all the traditional investment measurements and value measurements and investment principles out the window, but that's a classic Graham and Dodd buy right now, Fortuna Silver. And there's other stocks like that, not just Fortuna.
That's interesting, and that's one of the metrics that you were sort of looking at, obviously, as part of that equation, yeah?
Yes. So I guess kind of in sum, I mean, right now, I mean, unless everything completely falls apart and the market's completely shut down, the mining stock sector has the highest probability of giving you an outperformance of the general stock market for, at least the foreseeable future.
I think what's also interesting about that is it kind of jives. We were looking at market bottoms and buy points, and it kind of jives with. And I know you and I discussed this last time, and we both had a very similar assessment that the underlying gold and silver markets very much reflect the bottoming action we observed in October 2008, which structurally had become so disconnected from the real physical demand fundamentals, it blew the dollar price higher, the dollar price of gold higher for, I think, 3 full years in almost without any pullback. So that's interesting because you're now talking, I always love confluences. And when you've got a confluence of that and then what we were assessing last time, is there any more observations on that, Dave?
Yeah, I mean, I think we could be entering a classic bull cycle here where, gold leads the way, gold bottoms first. I mean, we saw this in 2000, 2001, and we saw it in, October 2008, although gold and silver kind of bottomed simultaneously and went higher then. And I think part of that is because the general precious metals sector investing audience got more comfortable with investing in silver and dealing with the volatility. And I mean, in a bull cycle, silver is going to outperform gold. But to me, gold is the bedrock that gets it started. And I mean, if you look at, brought up a chart here. I didn't know we were going to discuss technical aspects today, but if you look at a chart of gold, it looks like it may have formed a bottom at the end of September this year. And it's tested that bottom 3 times. And this last time it tested it was earlier this month, and it shot above the 50-day moving average, and it's getting close to the 200-day moving average. But if you look at, if you go back to May, the 50-day moving average has been resistance for gold going back to May, and that's really when the last brutal down leg to this sector was kind of in full swing. And it's shot above that. Now, I think it has moved a long way very quickly, and we could get a pullback here or consolidate sideways. I mentioned to someone yesterday that I wouldn't mind seeing a small pullback in the sector because I think it'll set up the next move higher. But yeah, I think there's a very real possibility that we could be entering a bull cycle here. I mean, a big bull cycle in the sector. And, if you I looked at that chart that you referenced a couple minutes ago, and right now, recently, that ratio showed that mining stocks were the 3rd cheapest relative to the stock market going all the way back to 2000. And the previous 2 times, let me see if I still have that chart here. The previous 2 times were at the end of 2018, which I remember the mining stocks took a real browbeating back then, before the famous Powell pivot. And then at the end of 2015, which, I mean, that was the most brutal down cycle from 2011 through the end of 2015 since the secular bull market in the precious metal sector got going in late 2000, early 2001. So I guess the point being is that I think, there's a high probability that if you invest in the mining stocks here and invest judiciously, don't bet the ranch on it, I think you have a good chance at making a lot of money over at least the next year.
That's interesting too. And I think, what we're talking about here is, again, we're looking at all these confluences. So mining stocks is something people should, and they can come and look at your data, look at your newsletter, and sort of get this live kind of, get the live sort of updates. But I think what we're saying here, this has suddenly become so interesting because all of these things. And again, it's like all these pieces of the puzzle seem to be coming together at once here. And again, I just keep coming back to what we talked about, this 2008 situation. I mean, we had a physical market that had become so disconnected at that point from the paper market. And bingo, what have we got here? Where we have not experienced that kind of structural imbalance since then. And all of a sudden we've got the insiders and on the long side, we've got the speculators on the short side. Hey, it's a casino. 95% of the time we know who's going to win this. So, I think so back then we saw, I think the 3-year rally was about $1,250 in gold and about $680. It was $1,240 rally from $680, and then silver, it rose to $40 from $8.50. I guess was so psyoped into getting this psyop operation that says, well, no, we'll just keep adding more paper, and then suddenly, Dave, and we see this, our wholesalers, and everyone is now turning to the Comex and saying, for silver, give it to me. Just give it to me. I'm happy to pay the 18 cents an ounce to fly it out. I'll have it in 2 days, 3 days. What the hell's going on here? This is time. And then when you don't have enough registered to cover that, and yet as a market maker, you've probably got eligible, you don't want to give that up. So you're going to have to get that eligible up for sale. Well, I mean, this is we've not seen. I think this is the kind of situation that drove the rally last time in silver and equally in gold. What are any fresh thoughts on that?
I mean, I don't remember. I'd have to go back and look at the data in late 2008 to I know the physical market was tight because we had huge premiums on silver eagles, and actually on a percentage basis we had big premiums on gold eagles, and actually all sovereign minted gold and silver bullion coins, much higher than normal, and that's usually indicative of some sort of tightness. For some reason, the suppliers of the blanks are being told, I assume, but are not supplying the mints, especially the U.S. mint, with enough material to meet the demand for silver eagles. So, and I honestly don't know why silver eagles command such a much higher premium than some of the other sovereign minted silver coins. I was looking at it the other day, and I'm not in the market to buy physical silver right now, but if I were, I'd probably buy the silver Philharmonics because they have the lowest premium to spot. But what we're seeing now, I think, is even more intense than what we saw back then. And I don't know what was going. You might know what was going on in the London vaults back then, but Ronan Manley is obviously doing some great work, investigative work, on the London vault situation, and there's been as he's shown, there's been a mass movement of physical silver out of London, with most of it going to India. So what I've been referring to, what we're seeing now, is classic case of Gresham's law, right? Bad money chases good money out of the system.
That is so true, and I think you just mentioned silver there. So before we moved on, so interesting. When you talk to your institutional clients, and obviously there's a blend. You've got your mining stocks, silver, gold, whatever might be a portfolio. Would you? I mean, obviously it varies case by case, but just generally speaking, if you're somebody, a stacker, and you're looking, well, you know what, I can see things are lining up here bullishly. Do you think would you say any percentage of silver to gold that would you advise?
Well, first of all, your mainstream institutions don't buy physical gold and silver, right? They think they buy GLD or SLV and they're fine. Oh, I got gold, I got GLD. Okay. If you say so. I mean, to me, possession of the metal is 100% of the law, right? It's 10/10 of the law. So I don't know that there's any magical formula, in terms of what ratio of gold and silver that you own. I kind of keep it at 50/50. I mean, it's not scientific or anything. Um, I just, I mean, they both have their uses, right? I mean, the gold is really you can store and preserve a lot of wealth in a very small storage space with gold, right? But silver, obviously, in a bull market, is going to give you a better rate of return. And wouldn't recommend looking at holding physical gold and silver as rate of return instruments, even though there have been situations in the last really since the Bretton Woods treaty was removed by Nixon. There's been situations where gold and silver are ridiculously cheap relative to fundamentals, money supply, etc., and they just so happen to offer the attribute of rate of return performance. And I think we're in one of those periods now. So, I mean, if you're looking to hit the cover off the ball, hit a grand slam, go 75 silver, 25 gold. For me, the way I look at the silver is if we do get into a situation that's going to require using precious metals for barter, or if we get into a situation where gold and silver are mandated as legal tender, right? Then for me, silver gives you fungibility, which is why I like to own 50% silver, 50% gold.
That's a great answer, Dave. I think that emulates what some of the smart money. When we go to our vaults, I was in our vault in Liechtenstein not that long ago, and I mean, it always staggered me that there would be investors who literally could easily invest in pallets and pallets of 1,000-ounce bars, and I've questioned them before, boxes and boxes and boxes of 1-ounce silver coins. I mean, just nondescript silver coins, and I remember questioning this was years ago. I remember questioning, well, hang on, why are you doing that? And he said to me, well, Andrew, what happens when this coin is worth 50, 100, 200? Then clearly that's going to be very difficult to be lugging around a big lump of silver. So and what you're saying is that this is a perfect medium of exchange, wealth preservation, gold, but the silver is usable, and it would be very difficult to confiscate silver. They may try with gold. I think it would be unattainable, but silver, I think, would be very difficult to confiscate.
Well, I mean, that's kind of a shady term, right? Because as it turns out, it's not like they went door to door and made people disgorge their gold back in 1934, right? From what I've read is that the only gold that really the government, some people turned it in voluntarily, not very many. Obviously, as you're aware, a lot of very wealthy people who owned, the old time $20 gold coins, they moved their metal over to Europe. I mean, when this guy was still alive, I knew a numismatic coin dealer who had made several trips over to Europe to retrieve family estates that included a lot of gold because they wanted to bring it back over here and sell it. So, what I think is, because you brought up the idea of coins, what I think is interesting is that I've always thought, once I felt like I was up to speed on the sector by 2003, a couple years of intense research. And I've always thought that if we get into a Weimar situation with the money printing, which we sort of have been already, but I mean, if people really think that the central banks are going to pivot again to try and monetize what's coming, the collapse that's coming, I think you're probably going to get into a situation where you see people taking fiat currency and exchanging it for anything physical of value, first and foremost being probably silver coins, because that's going to be that's going to be what the masses go for, right? Because by that time, the price of gold, you're not going to be able to buy very much for $20,000 or whatever, but you'll be able to buy a lot of silver. But I think if you buy silver coins, you're going to be paying premiums that are 100% a spot, because that's how little value it will be perceived that fiat currency has at that point.
Yeah, I think we did an interview with Andy Sheckman recently, and he was saying something about, silver was like 18, 19 at the time, and he was talking about $16 premiums. That's exactly what you're saying. This is wild stuff here. So I think you're right. I think those coins, because of their fungibility and because their usability, they will always command a really strong premium. Yeah.
One more thing, you brought up the point of your Kinesis vaults, and I own some silver in I don't know which vault it is, but one of your vaults. And just to kind of circle back about, looking at the metals as rate of return, or what type of percentage blend to use between gold and silver, what I would suggest is that you take the wealth that you want and that you want to have in physical metal that you possess, and just make it easy, 50-50. But you can use digital gold and silver services like Kinesis to speculate, right? Because it's a lot easier to move in and out of positions on a platform like Kinesis than it is to I want to shift some gold into silver, so I'm going to sell my gold on Craigslist and then try and find some, the lowest premium on silver. And it takes time and it takes effort. So if you do want to, and I fully support anyone who wants to speculate on the price direction of gold and silver. And if you want to do that, take some of your, sell some of your stocks and move some cash into a digital gold and silver platform. And then you can shift it around to whatever mix you want. If you want to go all silver, right? A couple clicks of the keyboard, and you can move your gold holdings in a Kinesis account, the KAU, into a KAG, right? The Kinesis silver. So, that's how if you want to speculate on gold and silver and play around with your ratio, just take some of your play money and you can do that.
Yeah, and again, you're talking about tight spreads, which is important. Instant way of converting one to the other.
Yeah, instant liquidity.
Yeah, good liquidity. But I think the other thing is, of course, you're never naked shorting anything. You have a physical, and should there be a revaluation, and you do hold, and again, at any one point, you'll be holding physical gold, physical silver, as you say, whatever percentage. And should there be a revaluation, you wake up one morning and the price has been revalued, you still got it. It's there. And you've never been tricked into saying, well, you know what, let's go a little bit further and short the stuff. Well, again, you're never going to make that mistake because you're dealing in physical markets, and it's important.
Well, I think anyone who takes the ETF vehicles out there and shorts the gold and silver market right now is nuts. Or shorts Comex futures. I think you're nuts.
It's crazy. We saw that in SLV. We saw that. Crazy. It's an illusion anyway. As you say, ETFs, they're just an illusion. You're never going to have delivery. But what's interesting is that despite the fact that we're seeing this lack of correlation between silver and silver and gold against the dollar, seeing actually that lack of correlation starting to break a bit. What's interesting is that the silver, they're still selling their ETF silver. The speculators, up until yesterday, we were still seeing outflows into a rising price, which is clearly breaking through the 200-day moving average, for example. That's a major point. And interestingly, this is a level, and obviously you were talking about what's so important. People forget. They moan. If you're looking at a 10-minute chart, people moan if it goes down a bit. No, you're right, Dave. You're absolutely right. You need some backfilling. You need to remove the tinder, the actual ignition tinder. When you get a dollar rally or a news beat, and you've got a gap, then that's how these things used to work, isn't it? You'd start frying or igniting these naked longs essentially. And then obviously you've got a huge move. But in the meantime, something we were just talking about a little while ago is to see these little bits of backfilling, very constructive.
Another interesting thing, and I did actually look at this chart before we got on the computer today, and one of my theses has been that what we're seeing, the price of gold and silver that you're seeing is being set in the paper market, which everyone pretty much knows. But I looked at a chart, and I said I think what's going on here is the hedge funds, because the stock, we're in a bear market now. I think the hedge funds, what they do is they're going long the dollar, because the dollar's been, the momentum chasing hedge funds, the technical hedge funds, and they're shorting gold and silver paper on the Comex as the stock market goes down. And I pulled up a chart that shows the S&P versus the price of gold for the last year, and that they've been moving almost in lockstep since started in earnest in late March. Remember, it kind of felt like in March and April, the sell-off in the precious metals sector got even more intense than it's been at any time since August of 2020, when it peaked and started heading south again. Well, I pulled up this chart, and I wish I should have put it on my laptop so I could share it. But I mean, the correlation is pretty stunning. I mean, just eyeballing it, it's got to be about 80-85%, the directional movement between gold and silver. So, but at some point, and we saw that same pattern in the late spring and summer of 2008. But then by the end of October, I think there might have been a brief rally in the stock market, but gold and silver started moving higher. And the S&P, and I'd have to look at the chart, to get the date right, but the S&P started heading south again and didn't bottom until March. So I guess my point, March of 2009. But this, the precious metal sector went crazy. I mean, the Amex Gold Bugs index doubled between early November 2008 and the end of 2008. 100% gain. And, the risk to being short any of this stuff, SLV, GLD, LBMA forwards, Comex futures, is that at some point we're going to get that dislocation again, where the stock market keeps heading south and the precious metals sector goes nuts to the upside. And I mean, if you're short, they're going to carry you out on a stretcher.
Yeah, into a bid-only market, absolutely. And I think what was also interesting in that period, it's an interesting period to analyze because of the similarities. And so really, at that point, in some of that 3-year move, we also saw gold and silver rising alongside a rising dollar at points. And that's interesting because people think, the correlated algos that we see, the speculators being led by the nose, is a tick up in the dollar, sell silver, naked sell gold. Why? It makes no sense, but that is the I guess the controlling HFTs, which is run by the house, trick the neutral algos, which are really just looking for a tick either side. They're agnostic to price, but they successfully lead them into trading this inverse correlation, and we end up in a position where they're naked short against the house. They're naked short against. And it's ludicrous to me that intelligent, as you say, you deal with a lot of these hedge funds. You're a hedge fund manager. You deal with your peers. It must blow your mind sometimes.
It's been a head scratcher for me for 15 years. The 15 years that I've been following the Commitment of Traders report on the Comex pretty closely. And I mean, no one can understand why the hedge funds just don't start doing the opposite of what they're doing. Because there's no way they're making there's no way they're making money on their paper precious metals holdings.
I mean, and again, they might be right in the middle, but they're grossly wrong at both ends. And somebody was asking me the other day, well, because I was saying, well, look, they've been adding these what are essentially naked short positions since March, which was we had silver at 26-ish, gold around 2,000 in round numbers. And then obviously we have the Russia-Ukraine thing, and I believe a psyops operation to stop doing what gold says it does on the box is run into a safe haven. Hey, war, why not sell gold in a war? I mean, ludicrous situation. But anyway, these guys were led by the nose. And the question was, well, how are they really wrong? Are they really wrong? Because, and the reason they're wrong is they are not sitting on all of these, a plain vanilla short position. What they've done is use short profits to double down, and double down. And so therefore, when it turns, and we've only seen the bottom layers of this get uncovered, when it turns, it's going to be a bid-only market. They are so deep in the hole, and you look at the option structures, and they've bet so strong against 2,000 gold, 25, 26 silver. They bet strong. Yeah, but the house is on the other side of this trade, finally, because they don't want to be in a position to deliver. So, shoot, I mean, when this goes bid only, they're going to be, I mean, the losses, what I'm saying is, I guess, the losses are not just what you bet. The losses are inconceivable and unlimited.
Well, I mean, I think, speaking of the house, the king of the house, the BIS, look at what they've been doing with their swap position. And to me, that tells you all you need to know about where this market's going at some point.
Yeah, Dave, we just did an episode about this, and you're onto it. So few people have actually realized that this is the reset. They're getting ready for a gold price reset. They have to be, because in January, as we moved into January, there was 501 tons short. It used to be 800 tons. But I mean, and again, this whole BIS short position. I mean, you remember Robert Rubin in those days, and it would be in the, basically what they would do is create, why not just take your physical, sell it into the marketplace, lease it out, and we'll give you an 8-10% yield, and you can invest that in the stock market. And oh, by the way, we'll make sure the price doesn't rise. Well, of course, okay, until Basel III regulations came in. And that evolved from the fracture of the March 2000 EFP breakup, where you've got $80 to $100 spreads between the physical and the paper market, where suddenly liquidity providers in the over-the-counter markets were turned on. Okay, right, give it to me. Well, panic. I've offset my position in another paper position. But guess what? That went bid only, so there was $80 to $100 spreads. So, and I guess really I think that was the key point, that they forced Basel III and SFR conditions upon the gold market, whereas they let every other category off the hook. And it's only only the gold market was forced to be NSFR compliant. And so in January, they come in with 501 tons. October report, as you've just rightly said, 7 tons. And our liquidity providers are telling us, you know what, on November the 3rd, that last 7 tons was squared. Dave, you've just said it. If the central bank of central banks is clearing up their shorts, why are people shorting this product?
Ignorance, I guess. I mean, there's, plenty of periods of time between 2000 and now when being short paper gold was the right trade, right? And I mean, I don't understand why someone would short gold and silver, especially right now, and especially have exposure to unallocated gold shorts in London. I mean, that again, that's playing with dynamite.
Yeah, and the very fact that I guess really, I mean, this hedge fund herd clearly are so siloed from reality that they don't look and do their homework and say, well, hang on, if the central bank is covering all their short positions, there's a reason for that. And obviously, the reason for that means the gold price reset has to be upon us. This is the first time in 50 years that we've seen that kind of activity stop. This is a pivotal moment as far as I can't see any other reason other than, well, of course they see other central banks coming in and buying physical gold, competing central banks, BRICS countries. I mean, you're going to sit on a short position? No. And of course, and then I think you mentioned, I think I saw in one of your reports, you were referring to Roman Vanelli's information about the World Gold Council and their this spurious 390 9 tons of Q3 accumulation. And I mean, we know that number is so fake. We know it's so underestimated. But I think the point I'm trying to make here is that on the other side of that, you've also got the Bank of International Settlements buying back gold, buying it back. So clearly, this is like, if I would say to anyone right now, if you're a stacker, and I never advise anyone to go and borrow money to do anything. If you're a stacker, holy smoke, what more information do you need than this price has to be going up?
That's right. That's right. The interesting thing about that World Gold Council report was that what was it, like 360 tons of gold that had they called it a mysterious buyer, which then Bloomberg, which ran the story first, echoed that term. And it was almost like it was intentional by the mainstream media to make it sound like, gold is connected to conspiracies out there, right? Because I do know a lot of very smart hedge fund guys who think that the gold investing community is they even now, with all the data that's out there, all the evidence, they still think that we're conspiracy theory nuts.
Well, I mean, okay. Well, I'd like to have a look back at this in the rearview mirror, and I think by the end of this year and by 2023, when you have enforced NSFR conditions in the spot markets which are deliverable, clearly that's going to force the Comex, the undeliverable Comex market, to raise a price that matches a real deliverable contract. And so I'd like to look back at them at that point and say, it was all a big conspiracy, wasn't it?
Schadenfreude, right?
Yes, indeed. They'll probably be in rags at this point, but
Get carried off the Comex trading floor in stretchers. like that scene at the end of the movie in Trading Places. Turn the machine back on.
Yeah, I mean, and the thing is, you don't have to be even smart. You just have to be, you just have to open your eyes. And I think sometimes wood for the trees. I think the more you know, the harder it is to understand, because it makes no sense. It actually doesn't. And so if you're if you're a stacker, and I'm not saying you're simple because you're bloody smart, you're a stacker, then you've actually you're a hell of a lot more intelligent and a hell of a lot smarter than these guys with multiple degrees, freshly out of university. Most of these guys on the trading floor have never seen a downturn, never experienced anything but an up market. Wow, this is going to be monumental when it turns.
That's right. That's a good point. Most fund managers that are running big funds right now have only known how to invest in periods of time when the central banks are printing a lot of money. And again, unless there's some type of extreme pivot, it's going to be like that. It's going to be like that for a while, and you're going to find out what a real bear market is like. I mean, I don't think you can say 2000, 2008, 2009, and the brief crash that we had in the spring of 2020. I don't think you can say those are bona fide bear markets because the Fed immediately started, turned on the printing press to rejuice the stock market and rejuice the bond market. So, if they're adamant about, they're not even going to need to shrink their balance sheet, which they're really not doing by very much right now. But if you look at the liquidity numbers they're available on the Fred database, the St. Louis Fred database. If you look at the liquidity numbers, liquidity is leaving the markets pretty quickly. And that's where we're going to see another big leg down as that liquidity continues to dry up. And a lot of liquidity has left the market and they haven't shrunk their balance sheet that much. So even if they just hold the balance sheet where it is, you're still going to see liquidity disappear.
Yeah, that's interesting. And I think just your thoughts, the bit of a shock that hit the Bank of England bond market, the gilt market. Surely that provides a teeny little window into just how interconnected this daisy chain, a potential bond market contagion is. Are we? How are we close? What are you seeing here? That surely had to scare the crap out of people.
What I'm surprised about is that we haven't heard about the same situation with U.S. pensions, because if BlackRock was marketing that LDI product and the interest rate swap product to UK pension funds, and believe me, they're making huge fees on that, there's no way they weren't at least marketing it to U.S. pension funds. So I do think, and again, there's no way to prove this, but to me, it's strange that we've seen massive volatility in all the markets, and we haven't heard of very many blowups yet. The UK pension thing was one, but I think the central banks learned their lesson in 2008, and I think when there's flare-ups behind the scenes, derivative-related flare-ups, I think they do what they can to douse it. But at some point it's going to get to be like playing whack-a-mole, where they'll take care of a problem that hasn't been reported yet or hasn't been evident in the markets, and fix it, and then another one pops up, and eventually it's going to get so big they're not going to be able to control it. Because no one can say for sure if you wanted to just look at OTC derivatives and what does the book look like on not just how much in derivatives are actually outstanding, but who's counterparty to whom. It's impossible to track because a lot of times if you're a counterparty on a derivatives trade, you're going to lay that off on someone else. So yeah, I think at some point there's going to be something like the UK pension blow up, only much bigger in magnitude that they're not going to be able to control, and then we're off to the races. There's going to be a scramble for physical metal that will, make the scramble in the late 1970s, look like an odd lot.
Yeah, and you're right. They just don't know, and I don't think the regulators don't even know. And I met with Andrew Bailey, the current head governor of the Bank of England, just as he was finishing winding up his tenure at the FCA, and we met after we had something read in Parliament about this precise situation. What happens if the too big to fail banks, taxpayer-funded banks, get in the same glue as they were in 2008? You think that the public's going to sit there and stand back and bail these guys out again? So we had it read in Parliament. We were amazed that it got read in Parliament, but it did, and it created this series of meetings. And one thing that blew my mind was Andrew Bailey said, "Yes, but Andrew, it's completely unregulated." Yeah, hang on, you're the FCA. You're supposed to know what's going on. Yes, but in other words, we don't know what's going on. And you've just said nobody, it's right. Nobody knows who the counterparties are. Nobody.
That's right. I mean, we saw that in 2008. I mean, everyone pointed to Lehman as being the catalyst, but really it started with Bear, right? And there were definitely waves throughout the derivatives world that, mini tsunamis that we didn't see, and then it's, the whole situation started getting even worse over the course of the summer. But in my mind, the real shocker was when Goldman almost blew up as a counterparty to AIG. And up until that situation became public knowledge, I don't recall reading anything or seeing anything that gave you any kind of indication that Goldman had that kind of counterparty exposure risk to OTC derivatives. In fact, they they were shorting credit default swaps into the clients that they were selling them to because they knew what was going to happen. And yet if I'm convinced if Henry Paulson wasn't Secretary of Treasury, I'm convinced that Goldman wouldn't have been bailed out the way it was. We might have had, the public bailout of the banks like we did, right? I think it was $800 billion in taxpayer money was given to the banks so they could pay bonuses that year. But I think, I think if they didn't bail out the banks, Goldman Sachs wouldn't be around right now. And I don't know anyone who saw that coming. Certainly the people inside Goldman Sachs probably didn't. And I think we'll see, I guess, just to circle back to now, I think we're going to see something like that eventually now. I mean, everyone knows about Credit Suisse, right? That's already out there. And they're furiously trying to raise liquidity. And you got to wonder, how much bailing out the Western central banks led by the Fed have been involved in keeping Credit Suisse alive. But I think at some point we're going to see a bank that's or even an insurance company much bigger than Credit Suisse is going to, all of a sudden it's like, whoa, that thing's blowing up.
As you say, it's a game of whack-a-mole because I think nobody knows what the situation is. And but it's one thing that we can't discount is that clearly the banking system is broken. It's really, you can see there's so much evidence that there's massive tail risk out there. And I can't believe that people are blinkering themselves to it and chasing, high risk stocks, etc. at this point, and not hunting for the safe havens.
That's all they know how to do.
and to even think the dollar is a safe haven. I mean, it's a safe haven because it's the best of a terrible bunch. But I was going to ask you what you think, because you're that side of the pond. We've seen the relentless Fed-driven dollar short squeeze, and I think, is this going to cause a derivative explosion or be a part of that? Because obviously there are foreign banks trade. They're forced to hedge their local currencies by shorting the dollar, and you've got this rally in the dollar. I mean, is the Fed going to have to step in and do something about it, or what?
That's a great question, and I mean, the way I think about that, and the way I've discussed it with colleagues, is it really depends on what their intent is with the current monetary tightening. Are they, doing the spade work for a global monetary reset? In which case, no, I don't think they'll bail the dollar out. But if they want to kick the can down the road again, then yeah, we're going to see, another massive bailout. And maybe it won't be the governments that kick into the kitty, but I mean, the central banks can just print money, right? Nothing's stopping them.
So full circle, back to QE?
If they're not trying to engineer a reset by letting the current system collapse. So, and again, I don't know the answer to that. I mean, certainly the track record suggests at some point we're going to see another massive round of money printing. It'll be bigger than, in my opinion, it'll be bigger than 2020 and 2008 combined. but it just depends on what the motive is right now for what they're doing. Because obviously, the central, at least I don't know about, the BOE or the ECB bankers, but the Fed's out there saying, oh, the economy's fine, labor market's strong, which it's not. Inflation is starting to moderate, which it's not. But it allows them to maintain their tightening program for now, right? To at least have that stance in public. So, but let's face it, the truth is the whole globe is falling into a nasty recession that probably turns into a deep depression. So, and again, I don't know if that's what their intent is, or if they're just trying to squeeze everyone so that we're in so much pain we scream for more money printing. I don't know.
Well, hopefully it's not the destroy everything to build back better WEF mandate, which is pretty much global by most leaders, are actually spouting the same stuff. But in other words, maybe you have to destroy everything first to build back better. For who? But for who? I mean, obviously, certainly not for the average person. But so I hope that, well, let's just say hope that's not the case. But again, I guess really it boils right back to what are you doing with your money now while it's still there, is to invest it in things that are real. And as you say, physical gold, physical silver, the miners that are related to physical gold, physical silver, and after 50 years of price suppression, I don't care which way you look at it, the Comex was formed after Nixon shut the convertibility window down. 2 years later, they formed the Comex to stop to stop basically the outflow of physical. And we now come suddenly. The flag. I'm shouting about this flag. It's popped up. It says, when you've got the central bank of central banks covering all their short positions, hey baby, what are we doing? Are we really not going long gold and silver for physical? But a final thought, Dave. Though you mentioned, obviously, I do encourage people to come and subscribe to your mining, obviously to your mining newsletter that is up to date, and you track stuff which, to be honest, the average person just would not have the time or the resources to do the kind of work you do, where you really drill down, and it's experience as well. It's like, to me, it's an algorithm in your head. What you just know what makes sense, and then you narrow down what is a massive field into, and this is why experience is so important, and this is why I'm honestly suggesting people come to you, and I said it last time, and I do think that, and I tell people all the time, look, go and check Dave out, because people keep saying, well, yeah, but stocks are risky, but what about those, the miners? And I think that's it. I think this is a time when people should look at what you've got to say, and for relatively little money, get into something which could be, as you say, a 10 bagger, a 100 bagger. It could be anything, but it's probably a hell of a lot better price than you're going to enter into at these suppressed prices.
Thanks, I appreciate that. And again, I don't emphasize it in every issue, but my longtime subscribers know, look, I advocate first and foremost, own physical gold and silver in your own possession. And then if you want, from there, you can then look at the mining stocks as a way to make a leverage bet on the upward movement in price in gold and silver. And there's nothing wrong with doing that. And I tend to focus on the riskier project development stocks, but I've also started looking at and recommending some of my favorite larger cap producers, which are, it's a more conservative play, but I mean, on the risk return spectrum, right now the return potential of owning the large cap mining stocks, and especially owning the micro cap project development stocks. The risk return, the return potential relative to the risk is multiples, as opposed to going out in the stock market and loading up on a tech stock, which, in all probability is going to get cut in half again in the next 6 to 12 months. So I do, I definitely put advice in there about managing your risk exposure, even to the precious metals sector.
Yeah, and I think this is interesting because what you just said is that there's a range of things probably to meet anybody's budget. So you could, if you're going to, obviously you're going to do a big cap, then you're talking about bigger money. But on the other hand, when you can, some of the micro guys, I mean, it's relatively little money to get a piece of that action. But again, that's a massive minefield. So, anybody going into that really needs a mentor or somebody who would say, because bottom line, I would imagine, if gold and silver go up and you've got the right structure and you've done your analysis, then clearly it should go up. I mean, in simple terms, but there is a minefield below that. And so I would strongly suggest, that's something for everybody. And I would really strongly suggest they do get in touch with you, because if you're looking for leverage, don't be getting paper gold and silver. If you're looking for leverage, as you say, get your physical, and then you maybe use a little bit of those assets to maybe just get in and have a look at something that could actually benefit you very, very strongly.
That's right. And I appreciate the recommendation.
Well, Dave, we know we trust you implicitly, and the market does, and you've got a long history, a big provenance. And I just thank you again for joining us. And I really ask you on a regular basis to come back, because I know people ask for you all the time. So thanks for coming back. And we're going to see you really soon again, I hope.
Hey, appreciate you having me on again. And believe me, I get more out of our conversations than I put into it. That's the truth.
But anyway, I must say it's a yin yang, and it's an equal thing. And thank you so much.
Thank you.
Thank you, Andrew Maguire and Dave Kranzler, for another fascinating discussion. And remember, everyone, buy physical, and make sure it's 1-to-1. Understand the difference between what Andy affectionately calls the casino paper, gold, and the silver markets versus the actual physical gold and silver markets. They're not the same. And don't be fooled by this. So with that, there you have it. There we have it for another amazing episode of Live from the Vault. And please help us spread the word about this channel by hitting that like button. It really helps out the episodes. Share it with everyone you know. Subscribe and click on the bell if you want to be notified as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.